Love it.
Hey, this is Jake Claver with the Future of Fortune podcast. Good morning, good evening, good afternoon, wherever you're listening to us from. I'm here as usual with my partner in crime, Byron Wolf. And today we are blessed to have a special guest, Rustin Delhi. Is that how you say your last name? I probably butchered that.
Deal. Yeah,
Deal.
deal. No problem.
See, there you go. Should have asked that before we got on here. But we were just talking before this, and we had asked Rustin kind of what his background was, and we thought we'd go ahead and jump in and record. So, Rustin, would you mind giving us? I know you deal with trusts, but just particular background on yourself.
Yeah, so I do a lot of trust and estates planning, set up a lot of business entities as well that go together with the trusts and estates that I do. Do a lot of tax planning. So I've got a Juris Doctor and then went on to Georgetown Law in Washington, D.C. and did some additional postdoctor work there at Georgetown Law University. So ended up kind of in a position where I do a lot of advanced tax planning, and currently the more complex and uncertain areas involve cryptocurrencies as well as decentralized autonomous organizations or crypto collectives, however you want to call them. So I end up doing a bunch of work in those spaces.
And where are you located?
I'm in Salt Lake City, but I
Okay.
end up working federally. I'm in DC, as I mentioned, a good amount. So I end up doing work, federal tax work from coast to coast.
Oh wow. Okay. Well, cool.
It's a
Let's.
wide open space right now too. It's they're setting precedents and creating laws. I think sometimes just to answer questions and like, what do I do about this? Well, what do you think you should do? And okay, yeah, we'll make that a rule. So
Yeah, we're starting to see a lot of sub-regulatory guidance in the tax space, internal revenue memoranda, and rulings coming out in the crypto sphere, but they haven't yet been bold enough to venture out and put out really clear rules. So there's a lot of uncertainties there.
Yeah. So what? I guess the first place to start would be. I'm sure you've seen some liquidity events in digital assets and potentially set up some trusts for people that have had those. What does that look like?
So it can look quite different depending on where the people live. If we have somebody in a state with a fairly high income tax, think California or New York, often what we're doing is making sure that the liquidity event has a nexus to a lower tax jurisdiction. So often we'll create kind of a trust that is non-grantor, meaning not taxed to the taxpayer in a state with a high income tax, and create that in a situs where we have a lower income tax. Think South Dakota or Alaska or Nevada are kind of some of the top jurisdictions for that. So often we're looking at just some basic state and local income tax planning. If we're looking at federal taxation, typically what we're trying to do is if the liquidity event does not involve a change in asset, we don't really have as many issues. For example, if we just simply have a great amount of appreciation, then the key is to make sure that we do have that asset included in the estate of the person, so we'll get an automatic step up in basis. So sometimes I'm doing some basis planning for some clients. So it just kind of depends on where they're located and what type of liquidity event we're looking at. I guess we kind of have to define what we mean by liquidity event.
Yeah.
Um, whether we're talking about an exit from a specific asset or if we're talking about an asset rapidly appreciating, so we have a lot of built-in gains. Those are kind of
Two different.
two ways we could look at this.
Right. Yeah, and ideally, the better scenario would be just to leverage the asset in some way and take loans against it. Am I correct?
Yes, and that's been a developing area with a lot of different private banks making available credit facilities that they can give you against some of your assets, including cryptocurrency. So they generally have a loan to asset ratio with the volatility of cryptocurrency. You're not going to get an enormous credit facility on your assets. You'll get a fraction of those, but then being able to turn around and take that credit facility to finance something that's pretty stable. The banks often want to put a lien against and collateralize something like real estate or life insurance. But to be able to use a liquidable asset like cryptocurrency to create a credit facility and then buy another asset is another area where I've done some work, and even helped to structure some private placement life insurance products based on that on crypto as a credit facility.
Very cool.
So like whole life, or are you seeing people use that for whole life?
Usually you'll do if you're using a credit facility from a private bank somewhere, and different private banks will offer this. And then there are some banks that specifically lend on personal insurance. If we're talking about whole life, we're talking about personal insurance. But generally speaking, we'll do a blend of whole life as well as an IUL, a universal, an indexed universal life product, because they both have different features that sort of hedge the risk. Because the real dynamic, if you're going to be leveraging something like a crypto portfolio in order to obtain a credit facility, you have to make sure that the interest on the credit facility that you're accruing for using the money to buy life insurance does not outpace the growth of the life insurance. And so if you're looking at whole life, let's just say for simplicity's sake, if the whole life policy is producing a 4.5 or 5% IRR, annual IRR, that credit facility needs to be pretty lean. It needs to be, you're hopefully lending it out at LIBOR or SOFR rates, plus whatever margin that the bank adds onto that. And you're playing arbitrage between the growth of the credit facility, the interest accruing against you in the credit facility, versus the growth accruing on in your favor on the life insurance. But these kind of leveraged life insurance products are one way to create liquidity without actually having to realize or recognize capital gains when we do have an appreciation event, one type of liquidity event. So loans are an obvious way to bypass some of the issues with liquidity.
Yeah, and it takes something that could be a short term if you need it for your personal liquidity, turns it into long term. And I think as people are taking advantage of the wash rule now. I don't know that that's going to be something you can take advantage of, for years after years. I think that will probably end. But that's a great way to hold on to, especially if you believe in the project. I love that as an option, or multiple options really, to keep your cash, or whatever you have invested in that crypto, in the long term, and kind of see that project out. So yeah, no, I love that. That's great feedback, Rustin. I appreciate that.
Yeah, and with the wash rules, there have been a few changes in recent years, so those will be changing slightly. None of the major timeframes are changing, but just some idiosyncrasies between different holding of assets and where the wash rules apply can kind of bite you. If you have different, I don't know if you're holding all your crypto in one trust or one LLC, but just be aware that those rules apply across entities, those wash transaction rules. So.
And when you're moving these assets, say you do have a liquidity event, and it's in your personal possession prior to moving it into an entity, a trust, what's the tax implication and when you're moving those things, or is there one?
There can be. If you're holding them individually and you move them into a trust where you lose possession or control so that it's out of your estate and you don't have in conjunction control, you lose possession and enjoyment of that asset. That is a completed gift trust, and you will have to file a gift tax return on that, and that will go against your lifetime exclusion. If it's more than, you have 16,000 of annual exclusion, and then a lifetime exemption currently of 12.6 million, set to go to, I think, 12.98 million next year. So you'll lose some of that lifetime exemption if you fully lose possession and enjoyment or control of that asset by transferring it. So just be aware that it gets it out of your estate, but you also lock in your basis when you transfer that asset from your estate into that kind of an irrevocable completed gift trust. You lose your ability to step up the basis. You have a transfer of basis under Section 1015 of the Internal Revenue Code, where if you'd kept it in your estate, the section right before that, 1014, gives you a step up. So you kind of always have to weigh out, and there's a risk that they'll take away that step up in basis. That's been on the green books of Democrats for a few years here. So You have to kind of weigh out the benefit of the potential of a step up versus getting it out of your estate. There's always that trade-off.
So can you give me an example for that for our listeners? Like at what threshold or in what instance would it be a good idea to go ahead and transfer it versus maybe hold on to it? Is there an amount that kind of makes sense for either of those situations?
Yeah, you really need to run the numbers in a spreadsheet. So it really comes down to it's a multivariable calculation. It comes down to what is your initial basis. So if you bought an asset at 100 and now it's worth 1,000, you're going to have if you transfer it out of your name, you're going to transfer that basis of 100 into that completed gift trust. And that means that it's out of your estate. So you're not going to have to pay estate tax on the 900 or excuse me on that 1,000 in your estate. So if that's think 100 million, I'm giving simple numbers for the sake of this example. If you bought it for a 100 and now it's worth 1,000, you can add as many zeros behind these hundreds or thousands I'm saying as you want. That estate tax at 40% could add up to an enormous number. Whereas the capital gains tax, depending on your own brackets, you might be at either a 0 if you have very low income, or a 15% if you have moderate income, or if you're above about $500,000 married, then you're going to be at a 20% federal capital gains plus your state tax rate on top of that. So you're kind of playing out two numbers against each other: the 40% federal plus if you have an estate tax at a state level versus your probably 20% federal rate if you're a high income earner. And your state tax rate plus the net investment income tax on top of that. So you kind of got some pyramiding of taxes that could put your liquidity event on capital for capital gains, your income tax somewhere close to almost 30 plus percent versus a 40% tax. So you have to kind of look at which of those is more attractive, the estate tax hitting you at the 40% rate versus the capital gains tax that your beneficiaries will have to pay if they ever, or you'll have to pay if you ever liquidate those trust funds.
Okay. And you can set up a dynasty trust or a waterfall trust to mitigate some of that.
Yeah, it won't mitigate the tax attributes passing between them. However, you can keep these assets in trust for a long time. So I was on the drafting committee for Utah's domestic asset protection trust, and it provides. I was also on the committee that extended our rule against perpetuities for 1,000 years. So it's a dynasty trust, can last as long as you'll see some erosion of the mountains before these trusts go away. They last a good long while. So you can keep them in there, but those tax attributes follow the trust. So if you put in an asset again with a basis of 100 that's gone up to 1,000, and then in 1,000 years it goes up to 1,000,000, you're going to have that original basis of the transferor, the transferor's basis tax over.
And anytime you liquidate that into cash or transfer the value to another asset, that's a taxable event. You're taxed on the difference between the basis and the amount it's accrued. Is that?
Yeah, you'll recognize that tax at that point where you transfer to a new asset or sell them off for cash. At pro rata amount, if you sold off less than the full amount, you just have a pro rata amount of that tax. The ratio would be applied to whatever. So you'd have that capital gains built in. But then again, you get out of the estate and generation skipping transfer tax potentially. Well, there's always a balance between, you have to kind of calculate which of those taxes is going to be greater for you. Often it's good to, if you can, keep as much of that available for step up, and sometimes it's good to carve it into multiple trusts. So you kind of have an option to kind of play both sides of this trade-off.
Okay, that makes a lot of sense.
Yeah, coming back to what you said earlier about loaning against or borrowing against the those assets, you can do that in the trust to help mitigate that. And I would argue, yes, it's definitely a numbers play. It's you got to compare the taxes, but transferring it from your personal name into a trust, man, I think it's like planting a tree. The sooner the better, right? Hopefully you did it, 200 years ago, but if not, let's do it today. So once it's in that trust, if you are running that trust correctly, and you're using it for what it's supposed to be used for, that generational wealth. I love what you said. You're avoiding that transfer tax. So even if you are paying it there, you're setting up the future generations if they use it the way they're supposed to and hold on to it and use it as a basis for any loans or to create additional assets that hopefully become income producing assets. That I would argue like the math doesn't matter, right? Like, in 100 years, the math doesn't matter today. But I agree, with what you said. Like, you really do need to look at the numbers, make sure it makes sense for you, financially. Definitely. I know you're not giving financial advice. We're not giving financial advice. It's all for entertainment. I'll let Jake do his little spiel.
Yeah, I'll put the disclaimer in here. So
I'll give my own disclaimer.
Okay.
Everything we've been talking about is so extremely attenuated and simplified that just even the transfer to the trust requires a lot of analysis, because you might violate some voidable transaction or fraudulent transfer rule on the way in. So the structures, just making sure you can get into them, get in the door into a trust is its own little thing. And then these transactions all take time. They have to get seasoned in. If you're borrowing and creating life insurance, the season that to get that to mature to where you can actually draw cash out, that might be a decade, give or take some years. So these things, you have to kind of look at your horizon of when you need your liquidity. And if you have a large estate, if you're looking at way more than you have exemption, if you have a estate much larger than 12 million, then before you put it in a trust, we might be putting it into an LLC and doing some amount of valuation discount planning by having a limited partnership or a limited family limited partnership attributes to the LLC, where we give shares to different peoples or different entities or different trusts for different people, so that we can get a lack of marketability, lack of control discount on the asset, so that we can sort of squeeze down a relatively large amount of money and have a much lower value. Or we might be funding the trust with installments, an installment sale, an IDGIT, an installment sale to an intentionally defective grantor trust. There's all kinds of techniques on how to get these funds into a trust, but we've kind of almost glossed over that part of it, which is just as much planning as setting up the trust, sometimes a lot more planning than setting up the trust itself.
So, oh yeah, I mean, what a great problem to have, right? Way too much money.